Hello and welcome back to Finspire's Focus on the Market series, the fourth quarter 2020 edition. We're going to recap another tremendous third quarter and a look ahead to the fourth quarter of 2020 and even get a glimpse into what we can expect into 2021. I'm Karam, Chief Investment Officer with Finspire, and happy to walk you through some of the charts that we have and some of our opinions that we have as well. As always, we're going to share these facts, but we're also going to share our insights and our expectations for the road ahead. So let's get to the keys to a sustaining recovery. We started measuring a handful of key areas of focus in order to sustain, at the time, was both an economic and market rebound. The third quarter saw a strong market continuation of the market rebound, market recovery. But we also got some negative news about the second quarter look back of GDP contraction. We'll talk more about that. But as we look ahead into 2021, the key area is going to be all about the successful solution of COVID-19, whether it's in the form of a vaccine or through remedies and therapies, and the delivery of a vaccine, an effective vaccine to tens of millions of people in the country is really going to determine future economic growth. Why? Because we have had a significant rebound that has taken advantage of a few things, both stable oil prices, a tremendously accommodative fiscal and monetary backdrop. The Federal Reserve's balance sheet expanded north of $7 trillion. Congress is talking about another round of relief and stimulus measures north of $2 trillion. And if you recall, the CARES Act, which was passed earlier this year, equated to somewhere around close to 12% of GDP through deficit spending. And as we closed out the September 30th fiscal year end, the government fiscal year end, the federal government, checked in about a $3.3 trillion deficit. An extraordinary and historic number in its own right, but that has been very supportive of both the economy and of the markets. Credit market stability, we'll talk a little bit about that. Credit markets were very unstable towards the end of the first quarter at the beginning of April, and they've slowly but steadily improved. We'll talk a little bit about that, but you need to have a stable credit market in order to have a sustained equity market recovery. Fundamentals are getting better, but we are going to experience probably a year-over-year reduction in corporate earnings. But this market, one of the reasons why it's advancing is looking forward. And so we'll talk a little bit about corporate earnings and what that means for future market growth. COVID-19 slides, it's well known, it's well marked. We've been inundated not just with the number of cases, but also the death rates. Now, the cases are going up, the death rates are coming down. That's overall good, but COVID-19 has done a number of things, including changing our behaviors, whether it's in flying. So we have data about TSA checkpoints, for example, which at one point were 96% below their pre-COVID levels in cases and the number of daily travelers. Today, we're about 590,000 travelers per day moving through those TSA lines, and you can see those numbers are still well below where they were pre-COVID. Another metric of what we call high frequency data points is in restaurant activity. So you can see at one point we were nearly 100% off restaurant activity from pre-COVID levels. Completely understandable given that we were charged to socially distance ourselves and not to gather in, especially in indoor places. And you can see here where certain pockets or certain states in the country resides in the level of the activity. Texas still down 29%. The US as a whole down 37% from pre-COVID levels. California and New York, two of the hardest hit COVID-19 states, and also states with pretty strict remaining lockdowns, down 43% and 59% respectively from pre-COVID levels. So COVID-19 is not just having a future economic impact by way of delivering an effective vaccine, but we've also seen a behavior change in the way we consume from whether it's a retailer or how we travel. And we'll need to see some improvement there if we want to see those sustained economic figures moving higher. Unfortunately, with some of those sectors of the economy that have been hit harder than others due to COVID-19, we saw just an incredibly huge spike in jobless claims, at one point exceeding 6 million people on a week in one particular week. We're down to a 4-week average of 867,000. But just to give you some perspective, pre-COVID, we were right around the 230 to 250,000 per week of initial jobless claims figures. And so we are on the right track, but we've got a long way to go, and we need greater confidence in our ability to either socialize or get back to work. We also need greater confidence in the economy and future economic future economic growth in order for us to see those weekly initial jobless claims fall to levels where they were pre-COVID. And just to give you a sense of where we are with economic growth, as you recall, the second quarter was dismal, right? Almost predictably, with GDP contracting 31.4% in the second quarter. The rebound, as you might imagine, with the resurgence in the equity markets, the economic rebound is real. And we are seeing estimates by the Atlanta Federal Reserve saying that third quarter GDP growth may come in somewhere around 35% positive for the third quarter. So that would be a sharp rebound to a very, very sharp decline in economic activity. But again, that's almost predictable based on the types of daily experiences we've been living through with COVID-19. And as people move back to work and in states reopen their economies. And we're also seeing it in just the raw data, right? The raw manufacturing and non-manufacturing or services sector, clearly in expansionary territory. And we do believe that throughout the fourth quarter, we're going to see these numbers be pretty healthy, especially as inventories needed to be rebuilt, whether it is for home goods, whether it's for things like lumber to build new homes as a result of lower interest rates, encouraging people to move into new properties or do home improvement, all the way through the auto sector as people's behaviors maybe move away from taking mass transit and opting for cars for transit. You're seeing a resurgence in manufacturing activity, which should carry us through the fourth quarter and with another positive economic growth rate to finish the year. So where are we with the markets? And you can see that despite the S&P having a 34% decline from February 18th to March 23rd, as of October 8th, the S&P 500 is up 7% year to date. It's a pretty remarkable turnaround, but it has not been uniform from asset class to asset class. Yes, you can see here in the last column, the best performing asset class at the top, the least performing at the bottom. You can see in the column that says 2020 to the far right, the S&P 500 is up 7.4%, followed by high quality investment grade bonds at 6.4%. Below that, you'll see some weakness, however, in these figures, where it hasn't been the same overseas with both emerging markets and developed non-US equities trailing the US, and in particular in the United States, small caps. Small companies have trailed mightily versus their large cap counterparts. And a lot of that is due to the big cap technology names that have fueled the S&P 500 higher. So Facebook, Apple, Amazon, Google, and Microsoft, for example, comprising the largest components of not just the S&P 500, but also of the technology sector. You can see year over year, the technology sector has performed remarkably well in this environment, with actually very strong earnings reports to support those levels, and contrast the energy sector, which has, as we documented, have experienced extraordinary volatility in energy prices throughout the year, has led to a 45% year over year decline in that sector. And you can see a lot of other sectors sandwiched in between. So it has been a very uneven, and it has not been a uniformly positive experience for all investors investing across different sectors. From a valuation perspective, with prices rising as a whole or as an index, and with earnings year over year coming down, when we compare and contrast those earnings from a year ago in 2019. Yes, the market is reached elevated levels of valuations. However, one of the areas that's critical to remember is that because interest rates have come so far down over the course of 2020, the dividend yield on the S&P 500 today is approximately 1.6 to 1.7%, and the yield on the 10-year Treasury is about half that. So what does that mean? That means if you have a long time horizon or any type of time horizon, if you prefer to take the dividend yield with the potential growth in equities, you buy equities over bonds if you have that time horizon. If you don't, you use those bonds to manage risk in a portfolio, and that's one of the reasons why the equity market is supported at levels at where it is today, is because perhaps the alternative is not so good. And to give you a visual aid of what that yields on treasuries look like, you can see we have it from the lower left of short-term yields, we're basically essentially at zero, all the way to 30-year yields on the right side of the chart. And for the first time in a couple quarters, we've seen the yield curve actually nudge higher. So compared to 1 year ago, which is in that orange and yellow color, where yields are pre-COVID levels, you can see post-COVID yields fell to the red line, which was 1 quarter ago. And then the latest levels, which was as of October 7th on this chart, shows you that that 10-year to 30-year yields have risen, both the 10-year from 0.62 to 0.81 and the 30-year yield from 1.31 to 1.6%. This could be happening for a number of reasons. It could be happening because we have future prospects for economic growth maybe improving, but also it could be due to the fact that the federal government has borrowed an extraordinary amount of money this year, $3.3 trillion in deficit spending, and perhaps with talks of another $2 trillion of relief and stimulus being talked about throughout Congress, perhaps the markets themselves, the trading markets themselves, and the interest rate markets themselves are telling us that you got to pay a higher price for that debt if you're going to take on more than where you are today. Credit markets, I mentioned earlier that it's critical that they stabilize in order to have a successful equity market recovery. And so far, so good. We've seen those yields come down, which means future expectations for example, defaults on debt are reduced. And that is being shown here in ways where you can see even high yield debt like CCC, B, BB, things that are considered junk bonds, the yields have come down from their peaks during the COVID, the elevated levels of the COVID crisis. Last but not least, we got to talk politics. So what's interesting here is politics is a very noisy market movement, has very noisy potential for market movement. It doesn't mean that things are going to always work out the way you might think, should one party be in power or not in power. Interestingly, we don't have because there's only a general election every 4 years, there's not a huge sample size here of data to review, but you always see these charts of under which types of presidents do markets do better or worse, Republican or Democrat. Reality is, as I mentioned, there's a lot of noise in the data. Markets do like certainty. They like certainty of incumbents. And so typically when you see the incumbent party poised for re-election, you see a run-up before Election Day, and then a continued run-up after Election Day. If you see an incumbent that's poised for defeat, you typically see a little bit of weakness in the equity markets leading up to Election Day, followed by a favorable market afterwards once the certainty comes into play that there's going to be a change in control. But it's not just the White House that matters. The makeup of Congress matters. So oftentimes, whether it's one party in control of the White House, another party perhaps control of Congress, it can create that environment where they're forced to work together in order to advance or change both regulatory and legislative policies to impact future market results. So I appreciate you being with us today. The third quarter was a very active one, but the reality is we have a very active fourth quarter in front of us. We don't just have more and more of this economic data. We also have a general election, which you're all aware is occurring in the early part of this fourth quarter. Later on in this quarter, you're going to see us again as we give you a mid-quarter update. It'll be a post-election special of what to look for, not only take a look back at the election itself, but we'll also take a look forward about what future economic prospects look like and how it could impact your portfolio. Thanks again for joining us. I'm Karam with Finspire.